Let's take another look at BlackRock Science Technology Trust, a covered call CEF that heavily focuses on the technology sector and offers nearly a 10% dividend yield. BST pays out its investors every month with monthly dividend payments. BST is not like your typical income ETF. For one, it's actually a closed-ended equity fund and not an ETF, which simply means the CEF shares, they are finite. They trade similar to that of a stock. So once the IPO or inception date happened in October 2014, there's only a limited amount of ways that more capital can flow into a CEF. This is different than open-ended ETFs, which just simply buy and sell securities upon investor demand, and there is an unlimited amount of shares. For this reason, the market price of the ETF and NAV, or total value of all the assets the fund is invested in, will essentially be the same. That's not quite the same with closed-ended funds. For example, BST currently has a market price of $30.63, but a NAV of $29.98, meaning the CEF might actually be overvalued or be trading at a premium. But this could also offer an opportunity at arbitrage when the market price trades under the NAV or trading at a discount. So that's one big difference. Another is that BST is heavily exposed to technology companies. Over 70% of the CEF is invested in technology in some way, whether that's software and services, semiconductors, tech, hardware, etc. BST will invest 80% of its total assets into science and technology companies of any market cap size, and they are being selected for their chances at rapid and sustainable growth from their products or services. 32% of the holdings in BST are actually less than $2 billion in market cap, which is actually pretty significant. BST is also invested in private companies, so not every holding it owns is public. They currently own 117 different holdings. Just know that private companies and startups can be very risky and illiquid to get money out of. This is one of the reasons BST is down so heavy in 2022. Some more established tech companies will pay a small dividend yield, but the vast majority of that 10% yield from BST will come from its options trading. Tech companies are known to be very volatile with huge swings based on the smallest bit of news or market conditions. But that makes them even more juicier for higher premiums when doing covered calls. Also, smaller market cap companies like the ones BST owns will be on Liver King type steroids with volatility and thus higher premiums. Their latest report shows the fund writes calls on 28% of its holdings at 10% above the current strike price 45 days out. So it's a little less aggressive than other income ETFs like QILD or JEPI. BST will likely lag in periods of bull markets, as some of their positions can get called away if the market does very well in a short period of time. As mentioned before, BST offers a dividend payment every single month. And unlike other income ETFs, where there is no rhyme or reason to how much is getting paid out each month, BST's payouts are actually pretty consistent. In 2022, every month featured a 25-cent payment, and 2021 was consistently 18.7 cents to 22.6 cents to 25 cents. This has been a consistent trend with BST since its inception in 2014. It is promising to see an income ETF raise their dividend over time. Probably the most amazing part of BST, and this is very unique to them, is that they actually have all their distributions taxed as long-term capital gains, which means they are getting taxed at more favorable tax rates. We can see in their November tax info supplement, all but 5% of their distributions year to date have been long-term capital gains. This is a huge difference from other income ETFs, which are usually taxed as ordinary income or at unfavorable tax rates. The reason for this might be due to BST's classification as a closed-ended fund. Another bonus is that in some years, the fund gives out a special dividend from all the gains it experienced in good years. This could often be quite fat, and that 10% dividend yield might be even higher in years when that gets paid out. BlackRock Science Technology Trust is owned by BlackRock, one of the most influential and powerful companies on Earth. The CEF controls just over $1 billion in assets under management. However, one big flaw to BST is that they charge a huge management fee for doing all this work. It's really expensive. While most income ETFs charge around 0.35 to 60 basis points for doing covered call strategies, BST charges a mind-boggling 105 basis points fee. That's $105 for every $10,000 invested. And remember, that's the fee that gets charged whether the fund actually returns positive results or not. The fee gets taken off the top. If we're going to be paying such high fees for this fund, it better be having some stellar performance. And that it does, as BST has actually outpaced the market since its inception 8 years ago, returning 13.2% annually each year compared to just 10.2% from the S&P 500. That's pretty amazing since the vast majority of funds cannot beat the market over long periods of time. Just remember, dividends are never guaranteed, and it looks like BST will fall heavily when the market doesn't do as hot either. It's nice to get close to a 10% return in dividends. Let's just hope that they don't dry up as well when the volatility goes down. BST is unique. It's a CEF that trades similar to that of a stock. It also has some more conservative covered calls. It also has proven that it can raise its dividend yearly, and is also more consistent in the amount of distributions it gives out. And probably best of all, the vast majority of dividends have historically been at favorable tax rates. Now, I'd love to hear your opinion on BST below. Does it have a case to compete with JEPI, JEPQ, Q-Yield, or any of the other popular income ETFs? If you like this video, please be sure to help out a small-time YouTuber by hitting that like button. And as always, my videos are always found in podcast form under the Clyde Cash podcast name. And I'm out. I'm out. I'm out.